Hi, it's like was already mentioned today, very nice to finally see live audience again. I just ran in my head and calculated that the last time I spoke before the live audience was 9 months ago, so time flies. And as Vilius said, it's nice to see a lot of familiar faces. I cannot share the experience. The only thing that is familiar is masks in the room. I have not gained the experience to recognize people from their eyes and smiles which are hidden behind masks. But hopefully very soon, actually, we will be able to interact and communicate without masks. And it's the nature of the Economist to look for the problems and to identify the problems, even if there are none. And for the past more than a year now, every economist have started their presentations with a look at the COVID-19 situation and what is the status with the new cases. And I was tempted to write the title of this slide, Out of the Woods, but then I remembered that last summer, the feeling was that we were out of the woods. It was all fine. The number of cases dropped to almost zero. Everybody was interacting. We had live conferences and so on and so on. And even though the number of new cases now is again approaching rapidly zero, we cannot be very certain that the new wave will not arrive in autumn. What is very different from the last year is that we have now vaccines. And the vaccination process, especially around the developed countries, is very successful. And we see that in Lithuania, for example, the number of vaccinated people is more than 1 million. Almost half of those have received at least one vaccine. 65 vaccines per 100 people. So it's a matter of weeks before we reach so-called mass immunity, which allows us to move around freely. Of course, there are risks related to mutations, especially in those countries that do not have access to vaccines. But I'm reluctantly and carefully saying that this may be becoming the problem of the past. So now, what kind of problems we should be looking for in the future? As I said, you know, it's a dismal science, economics, and our nature is to look for the problems. But before that, I want to highlight something that should make us very happy about the current prospects and current economic developments which we can enjoy. And I remember at the onset of the pandemic during spring of 2020, there were a lot of gloomy forecasts about the prospects of Baltic economies. We were forecasted to have a much deeper recession than euro area as a whole, based probably on the experience that we had after the global financial crisis. And during the global financial crisis, this was not the case. Actually, Baltic countries suffered less due to many reasons. One reason is the structure of the economy, a smaller dependence on incoming tourism, very favorable export structure, timely and sufficient government support, and other factors led to the situation where we had very mild and short-lived recessions. What is more interesting is that even the second wave of the pandemic, which was very fierce across Baltic countries and led to long, stringent lockdowns, it had very mild, almost negligible effect on the overall economic developments, bar the few sectors that were actually negatively affected because they had to close down their activities, you know, accommodation, catering, and some entertainments and other services. But the rest of the economy, I can safely say, was booming for a year now, almost, since the last summer. And you can see that even in the first quarter, Estonia and Lithuania already exceeded the pre-pandemic level in terms of GDP. This was hard to expect any time during the spring or summer of last year. The forecasts were quite gloomy, and now we see that due to many factors, we had actually seen economies pick up and reach very quickly and exceed very quickly pre-pandemic levels. And it's not only GDP. Of course, the structure of the economy has changed. Now we see a smaller share of the economy is created in the HoReCa sector. Manufacturing has expanded very healthily. We see rising sectors, but very soon we will see a very broad-based recovery, which is indicated by increasing and even very high confidence across sectors. It's not only manufacturing that is booming. We see even the services that are only just starting to open up, they are very confident about their economic prospects. And current forecasts for many euro area countries, especially in Club Med, in the Mediterranean region, the expectation is that the economies will rebound and return to the pre-pandemic level at best at the end of 2022, maybe in 2023. Yes, they have suffered very big recessions due to both the virus and the loss of tourism. But what we see already now, revival of tourism will be as rapid as it was in, for example, manufacturing. Manufacturing has shrank very quickly to very low levels in spring of 2020, but now it's well above the pre-pandemic levels in almost all countries around the world. Demand for goods has replaced the demand of services which were not available during the pandemic. We see, for example, in Lithuania that consumer confidence is above the long-term average, and overall economic sentiment is not only above the long-term average, but is back to the pre-pandemic level. I will repeat myself, it was really hard to expect that this rapid rebound will happen. Now, if we look at the retail trade and manufacturing, we see that the recovery is not based only on successful recovery of manufacturing, but also household consumption is already above not only the dismal last year's level, but also above the 2019 level, especially in Lithuania, where consumers were not really concerned neither about the virus, nor about the pandemic, nor about their financial situation. They continue spending. If they couldn't spend money in restaurants, they were spending money on goods or some other available services. If they couldn't travel to Italy, they traveled to different cities across Lithuania or across Baltic countries. So domestic demand, local demand did not suffer. The manufacturing growth is a separate success story, I think, especially in Lithuania, due to new factories that are supplying reagents for vaccines produced in United States, and for that reason we see a very rapidly growing manufacturing. And actually, it would be quite hard to find macroeconomic variables which would be spelling trouble for Baltic countries. If you look into some euro area countries, you can see there's some distress here and there. But most of the macroeconomic indicators that are relating to Baltic countries, they are exceptionally positive and signal exceptionally positive developments. On top of the fact that we are already above the pre-pandemic level in terms of consumption, manufacturing, employment even, or wages, we see that this crisis has been remarkable in many respects. And one of those remarkable aspects was that households and corporates have accumulated a lot of savings during the pandemic. And especially again in Lithuania, household deposits grew by 20%. Partially, this was precautionary savings when they were afraid in spring of 2020. Then later it was forced savings because they couldn't spend money on the things that they wanted to spend on. On top of that, of course, income was growing very rapidly. Not only wages, but social income, social benefits, temporary social benefits, and so on and so on. Everything has filled up the coffins, the accounts, and the pockets of households across Baltic countries. And similar situation is for corporates. Part of these additional savings by corporates is related to government support. And for example, tax holidays provided by governments allow them to accumulate and postpone these tax payments, which means that this amount of deposits growth will moderate, but still this sends us a very clear signal. Both when it comes to households and corporates, we have a lot of pent-up demand. It's not likely that all of this saved money will be spent out quickly. Some of it is moving into real estate, some of it is moving into alternative investments, but Of course, some households, especially middle income and higher income households, will be willing to travel and regain what was lost during these pandemic years. And in general, I think it's worth mentioning that from a broader and longer perspective, that the growth that we have seen in Baltic countries since the accession to European Union and during the past couple of years was not driven by increasing financial leverage. And we see that household financial leverage measured either by debt as GDP, debt to GDP or debt to income has actually been declining. So at one hand, it shows that we still have a lot of untapped potential when it comes to growth. On the other hand, it shows that we are not very susceptible to external shocks, and these not over-leveraged households and corporations means that this is also one of the reasons why the effect of the pandemic was quite mild. The economies were balanced. There was no real estate bubbles, no over-leveraged private sector. For that reason, the economic slowdown and recession was short-lived. This, I will not surprise you with, this is the common unusual consequence of the pandemic all around the world, increasing real estate prices. It's hard to find a place where real estate has become cheaper during the pandemic. In many countries, housing prices have hit record highs. The exceptionality, perhaps, of the Baltic countries is that despite the rapid growth in housing prices, affordability did not decline, because at the same time, interest rates remained low and or even declined, and wages have been increasing rapidly. So the housing affordability index, which we calculate, remained close to record highs. And it means that housing for an average household, average apartment for an average household with average income is still quite affordable. But going forward and going towards the problems now is something that, of course, will attract more and more attention. I mean, if the pace of price increases continues, then affordability will start declining. And what we see in our main export markets is that euro area as a whole is also recovering very rapidly. And if you looked at this slide, the purchasing manager indexes in manufacturing and services sectors, it would be hard for you to guess that we still talk about the crisis or that the euro area is still in the crisis. Manufacturing sector is firing on all engines, very rapid growth and expectations of the ongoing activity. And even services, as the Europe only picks up and opens up after the pandemic, already now signals the rapid expansion. And in that context, of course, it is very interesting that we see an ongoing monetary stimulus and fiscal stimulus of a very large scale. This was necessary in 2020. It was necessary to supply ample liquidity, to set very low interest rates, to provide massive fiscal impulse to prevent economic scarring and prevent the increase in unemployment. Now, what I'm starting to worry about is that perhaps monetary stimulus and fiscal stimulus may become excessive and will be retracted rather too late than rather too soon. And this is a problem because politicians and central banks are unwilling to risk retracting the stimulus too soon. So they would rather print money and keep interest rates too low for too long. And at the same time, governments have the room and have the mandate to run massive budget deficits. As you know, fiscal rules have been suspended in European Union. So basically you can run as large budget deficit as you want, and you can borrow as much as you want with the help of the European Central Bank. So we saw already quite large increase in debt, especially in those countries that already had a very large debt. So that already raises a question, what's the sustainability? And in Greece, for example, debt to GDP has increased above 200%. In Italy, you see it's about 150, but will be much higher this year. And the fiscal stimulus is likely to continue. This was justifiable last year. This is justifiable to a large extent this year. But going forward, if this continues, the main consequence, of course, of this policy, combined with the very low interest rates and increasing monetary supply, combined with ample savings in private sector, this accumulation of deposits in households and corporates is not unique in Baltic countries. It's across developed countries. And already now we see excessive demand, which is not met by supply capacities in manufacturing, in commodities, in many services sectors, which will lead, it's a textbook example, which will lead to a higher inflation. And this is leading now already to high inflation. Central banks are saying that this, don't worry about it, it's a temporary thing, maybe. Part of it is temporary and related to supply bottlenecks in transportation, for example, or in the commodity sector. But in many countries, we already see something which is not temporary. And for example, wage growth in Lithuania didn't slow down last year, 10%. First quarter of this year, almost 10%. Similar situation in Latvia, accelerating in Estonia. Increasing number of companies are saying that the most important factor that is limiting and obstructing their expansion is shortage of labor. Shortage of labor, rapid wage growth, of course, it's a sweet spot for many employees, a headache for some employers, but from the purely objective economic perspective, I mean, if you see wages growing 2-3 times more rapidly than productivity for 3, 4, 5 years in a row, that there's no way it cannot lead to loss of external competitiveness. So cost competitiveness is being constantly eroded, and this is very important for Baltic countries. We are among the most open economies in the world. 70–75% of GDP is exports of goods and services. So you have to work, if you want to see rapid growth in wages, that has to be one way or another way followed by rapid increase in productivity. And we have been successful ever since we entered the European Union. You can see that our global market shares have been increasing. This should not be given as a certainty and as a fact. And this is one of the risks with a very rapidly growing wages, that this could lead to a loss of external competitiveness and slower growth of exports going forward. So this is the current situation. I'm sure that all 3 Baltic countries and many sectors will enjoy the next 2 years. But while we enjoy that, of course, we have to prepare for more difficult times when the monetary and fiscal stimulus is retracted and perhaps competitiveness will not be as high as it is today. Thank you.
Thank you very much. Nerijus, I know that you will not be able to join our discussion, so I will abuse my position and ask one question. Can I? Yeah, okay. And I think you will need a mic so that our viewers online can...
I'll get back here.
Oh, great.
Okay.
So, yeah, you mentioned inflation, and of course everybody speaks about inflation. And I heard a lot of people talking that inflation, there's hidden inflation. So the things that are increasing in price and that are not reflected, and especially we are hearing this about this in some construction and so on. So when should we start worrying really about the inflation, or what indicator should we watch other than this consumer price index to plan our businesses?
I mean, inflationary pressures in Lithuania are everywhere where you look. You know, it's producer price index, commodity prices, transportation costs, wages. It's across the board. And we've seen this during the past 10 years or so. You had a spikes in for example, food commodity prices or some industrial metals. But it was, you know, some localized issue which was quickly resolved. Now it's across the board. I mean, it's difficult to identify a commodity or a service which is not becoming more expensive more rapidly, either due to supply restrictions or due to rapidly increasing labor costs. So, I mean, we are here. I mean, the thing is that what we have to differentiate between is a lot of people are worried that due to the increase in money supply or what is usually called money printing, we will see some sort of hyperinflation, where inflation will become higher than 10% and prices will double. But that's not a very high risk. I mean, when we talk about higher inflation, what we should be worried about is that if, for example, in US or some euro area countries, inflation will go up to 5%. 5% would be a dramatic thing. Developed countries, G7 countries, have not seen 4 or 5% inflation for the past 30 years. And everybody got used, and because of that very low inflation, which was on average below 2%, interest rates dropped to a very low level. And financial leverage, especially in corporate sector, went to astronomical levels, and especially in the United States, not in Baltic countries. So the big problem here is that if inflation goes to 5%, if Fed has to raise interest rates to 3%, we will see a lot of defaults in these subprime corporates, let's call them this way. So this is what is my worry, that Lithuania has already now annual inflation is 3.5%. It can still go a little bit higher, but unlikely to go much higher. The biggest problem is probably not inflation in Lithuania, but inflation in those bigger economies that will have to react with the monetary instruments.
Thank you, Nerijus. Thank you very much, and thank you for answering this additional question.